Happy new trading year, guys. Welcome back to the channel. It's the first week of 2026 and markets are already showing just how unpredictable this year could be. Just before we move into today's lessons, here's a vital information that all traders should know.
The information provided in this material by Renaissance Capital is intended solely for educational and informational purposes. It does not constitute financial advice, investment recommendations, or an offer to trade any financial instrument. Trading in Forex, CFDs, and other leveraged products involves a high degree of risk. You may lose part or all of your capital, and you should never trade with money you cannot afford to lose. While every effort has been made to ensure the accuracy of the information contained herein, Renaissance Capital assumes no responsibility or liability for any financial losses or damages resulting from the use or misuse of this material. Readers are strongly encouraged to seek independent financial or professional advice before engaging in trading or investment activities.
Our regular viewers already know how we approach the market from our trading methodology. We usually commence trading from the place of fundamental analysis to sentimental analysis, then move to technical analysis using our top-down analysis and price action concomitantly. So let's begin the financial market in hindsight. Just days into the new year, we are seeing fresh geopolitical shocks that have traders on the edge already. We haven't even fully digested the fallout from last year's tariff battles and prolonged US government shutdown. Events that skewed economic data and made for a messy end of 2025. From our financial market hindsight, this is where we discuss what moved prices and where we're expecting to see the next catalyst come into the markets. The first headline that caught the market off guard was when it was announced that the U.S. forces captured the Venezuelan president Nicolas Maduro and his wife in an overnight military strike and flew them to New York on federal charges. On Saturday, January 3rd, 2026, the United States launched a special military operation in Venezuela, codenamed Operation Absolute Resolve. In the early hours of that day, the U.S. forces carried out a targeted strike that captured the Venezuelan president Nicolas Maduro and his wife Celia Flores, removing them from Caracas and transporting them to New York to face criminal charges in the federal courts. The Trump administration says the operation was aimed at dismantling Maduro's regime, which U.S. prosecutors alleged to run a narco-terrorism and drug trafficking network and contributed to organized crime affecting American communities. Maduro and Flores had pledged not guilty and contested the legality of their seizure. Beyond the official narrative, many analysts believe strategic interests, including Venezuela's vast oil reserves and reducing foreign influence in the Western Hemisphere, was also factored into that decision. Meanwhile, on the economic front in US, the first data we got, the US ISM manufacturing PMI recorded a lower figure than market anticipated. Meanwhile, on the economic front, the US ISM manufacturing index data released this week showed continued weakness. The index slipped to 49.9 in December, below expectations and firmly in contracting territory. A reading below 50 signals slow factory activity that can weigh on the US dollar and broader economic risks. The weaker data paired with geopolitical uncertainty has contributed to a softer dollar and a heightened volatility across FX, commodities and equities markets. On Tuesday, on the economic calendar, we had the Euro preliminary CPI and the PMI figures, both undershot market expectation. The recent European inflation and purchasing managers index data shows a faster than expected cooling in consumer prices in Germany and France, alongside mixed services sector performance across major economies. These developments may influence the European Central Bank's monetary stance going forward. Preliminary inflation figures in Euro area indicated that the headline consumer price inflation is to around 2% in December 2025, down from what we had in November, which was 2.1%. Aligning with or slightly below market expectations, bringing inflation back to ECB's target range. On the core inflation side, which exclude energy, food, alcohol, and tobacco, also softened modestly. In Germany, the annual inflation slowed more than anticipated, with an harmonized index of consumer price index falling to approximately 1.8%, below forecast and significantly lower than previous readings. France inflation also eased, with preliminary HICP figures around 0.7 to 0.8% on the shooting expectation as energy cost declined. For service PMI, the latest Eurozone service PMI came in at 54.2 for December 2025, revised lower than earlier estimates and down from prior months. This still points to ongoing expansion in the sector, but at a slower pace. Regionally, Spain's service sector has notably outperformed its peers with a service PMI above 57, one of the strongest in the euro area, reflecting robust domestic demand and higher new business inflows. By contrast, service activity in France and Italy was more subdued, with PMIs close to stagnation or modest growth, while Germany's service sector continued to expand, but at a decelerated rate. Now, the implication of this is that although inflation in Germany and France is cooling faster than economists had forecast, this does not by itself constitute a dramatic policy shift for the ECB. Instead, the softer price pressure may reinforce the ECB's current stance of maintaining interest rates at restrictive levels, while allowing policymakers room to exercise caution on further easing. Markets are now pricing in a lower probability of aggressive rate cut this year, given ECB's emphasis on sustainable progress towards price stability. Despite slower inflation, service inflation remains a key area of focus, lingering above targets in core measures, which could mitigate expectation for early or deep monetary loosening in the near future. Meanwhile, Spain's resilient service performance highlights a heterogeneous dynamics across the euro area, underscoring the need for a nuanced economic assessment. While on Wednesday, due to the ongoing rift between the US and Venezuela, it has kind of shake the oil markets. We have this headline here that says that oil prices continue to grind lower due to the fears of oversupply in the market. Oil prices extended downward as a result of this data. The oil prices extended their downtrend as markets reacted to fresh geopolitical development, and macroeconomic data. Meanwhile, in Australia, we got a trimmed main CPI. This headline that says Australian trimmed CPI is marginally in November. Australian inflation outruns and mixed labor market indicators provided a complex backdrop for risk assets and central bank's expectation. For oil, the WTI crude price fell by more than $1 per barrel following the statement from U.S. President Donald Trump that interim authorities in Venezuela would transfer about 30 to 50 million barrels of sanctioned crude oil to the United States. The crude is expected to be sold at prevailing market prices, with revenues that will be controlled by the U.S. administration. This announcement sort of reinforced expectation of an increased global supply and contributed to the bearish sentiment in crude markets. Reports indicate that Trump is planning engagement with executives from major energy companies, including Chevron, ConocoPhillips, and ExxonMobil, to discuss potential investment and redevelopment of Venezuela's oil infrastructure, which could further support future outputs. In Australia, November consumer CPI, consumer price index data undershot market forecast, although underlying price pressures remain elevated. Headline inflation slowed to 3.4% year-on-year before expectations, and reflecting softer price momentum. On a monthly basis, CPI was flat, indicating limited immediate upward pressure on prices. The Reserve Bank of Australia preferred measures of core inflation. The trimmed mean CPI is only marginally to 3.2% year-on-year, remaining above the central bank's target band of 2 to 3%. These figures keep the risk of further rate hikes alive ahead of the RBA's second to third federal policy meeting, although the balance of evidence still leans towards a policy hold unless inflation proves more persistent than expected. In price, the Australian dollar initially dipped following the CPI release, but rebounded, reflecting market positioning and broader currency flows. Next, we had data from the US labor market, and here's the headline: November job opening figure reinforces the theme of a cooling labor market. The US data painted a mixed picture of labor market conditions. Before the jobs numbers were posted, we also had the ADP non-farm employment change figures that came in roughly in line with market expectation. It was the figure we got was slightly higher than forecast, so it was indicating the continued job growth in the private sector thereabouts. Then for the jobs job opening showed that openings declining approximately about 7.1 million in November, the lowest in over a year, and pointing to a cooling but orderly labor market. The same day we had the ISM service PMI reported a stronger than expected figure. Now, when we consider this data altogether, the combination of a softer JOLT report in line with ADP employment data and a stronger service PMI does not offer a clear directional signal, reinforcing the view that Friday's US non-farm payroll report will be pivotal especially for market sentiment. For traders, current data supports the narrative of a soft landing for the US economy, one in which labor demand moderates without a sharp deterioration, thereby tempering urgency for aggressive Fed Reserve rate cuts in near term while preserving room for gradual policy normalization. If disinflation continues, market and youth will remain highly sensitive to inflation and payroll data rather than JOLTs figure on their own. Also, somewhere on the horizon, we have this week is a potential US Supreme Court decision on tariffs, which could add another layer of directionality for risk assets and commodities, making it a key catalyst for market beyond the economic calendar. The next headline we had came into the market on Thursday. Headline says Swiss inflation met expectation, while softer US jobless claim helped stabilize the US dollar after a period of weakness. The Switzerland's month-on-month consumer price index came in exactly in line with market expectation, offering no major surprise for investors, leaving the Swiss National Bank policy expectation largely unchanged. In the United States, the initial unemployment claims came in lower than expected, signaling a relatively stable labor market. The 4-week moving average of initial claims fell to a cycle low, reinforcing the view that layoffs may remain limited. However, continuing claims edge slightly higher, suggesting that while fewer people are losing jobs, those who do are taking a bit longer to find new employment. Before this data, the US dollar had been under pressure following a series of weaker than expected economic releases, which market interpreted as a sign of slowing economy. The implication for this in price is that following the jobless claim data, US dollar strengthened against major currencies, particularly the euro. From a trading perspective, the move was relatively smooth, especially for traders who waited for pullback near the end of the London session before entering a long dollar position. The next headline came in on Friday. We had the NFP report for 2026, which showed a labor market that is gradually recovering from weakness seen at the end of last quarter. We also had the Canadian economy jobs also. Canadian economy posted figures that confirmed the weaker labor market. Last time we had 53,600 jobs added, but this time we only had 8,200 jobs added. So that's kind of showed how the job markets job availability has slowed down in Canada. A higher unemployment rate for the month of December weakened the Canadian dollar against other major currencies. This should encourage the BOC to cut rates or further stay on the side. In price cards soften across the board, especially against the dollar. The first US non-farm payroll report of 2020 shows a labor market that is gradually recovering from weakness seen at the end of last quarter. The average hourly earnings met expectation, rising 0.3% compared to 0.1% in previous month. In terms of job creation, however, that fell short of forecast. The market expected that 66,000 new jobs be added, but only 50,000 were recorded. The unemployment rate declined from 4.6 to 4.4%, beating the market expectation of 4.5%. This drop in US unemployment became the major highlight of the report. In the market, the US dollar gained strength against major currencies. Regarding interest rates expectation, the Federal Reserve is currently projecting one rate cut this year, while the market participants are pricing in two. Based on this data, we may begin to see a reduction in how many rate cuts the market expects for 2026. We also closed the week with a positive reading in preliminary consumer sentiment, while inflation expectation came in line as forecast. Now, to sum up what characterized first full trading week of 2026, we have seen geopolitical tensions kind of increase the uncertainties around markets predictability at the moment, with the ongoing rate between US and the Venezuela government, and the Supreme Court ruling on tariffs has also increased the uncertainty. Sometimes market favors the judgments of the DOJ against the normal markets economic calendar. Geopolitical risk is elevated. Geopolitics is now a core driver of market sentiment. Economic indicators are signaling a slowdown, especially in the manufacturing sector, which suggests that the U.S. economic cycle could still face a headwind in the coming weeks. Volatility remains a key theme. Market hates uncertainty, and right now there's plenty of it. This week, let's take a look at what is driving price. Is where we monitor upcoming market catalysts. The first headline that shook the market this week, the headline here saying that Trump's renewed pressure of the Federal Reserve raises concerns over central bank independence. Markets opened the week focused on fresh political pressure on Federal Reserve. President Donald Trump intensified his criticism of the central bank, questioning its independence and publicly targeting the Fed chair, Jerome Powell, including references to a criminal investigation. The move was widely interpreted as an attempt to influence monetary policy and undermine, the Fed's institutional autonomy. In regard of the implication for this, the financial markets reacted negatively. The US dollar and the US equities both came under pressure, selling off in the early trading as investors priced in higher political risk and uncertainty around future monetary direction. And that's kind of some of the activity in the market on Monday. On Tuesday, we have this headline, the ADP employment change also came into the market. ADP weekly 4-week moving average of private employment edged up slightly from prior week. This sort of gave the dollar some form of cushioning from what transpired in the market on Monday. On Tuesday, we had the US core CPI month-on-month came in lower than expected. When this data was released, dollar softened to seem the market is more attentive to the Supreme Court decision on tariffs and geopolitical tension. That kind of triggered a risk of sentiment in the market, and in a normal circumstance, when we have this a lower CPI, dollar is expected to weaken there because some geopolitical risk come into the market. When US President Trump had said that he would attack Iran, the core PCE data was completely ignored, and dollar benefited as a safe haven asset. And just yesterday, we had the US retail sales and the surprise index data came in line with market expectation for December. In price, market participants didn't really react to this price, as we saw dollar was neither here nor there because the market didn't really react to and we saw the end of London session, dollar rallied to close somewhere around the opening of the trading day. Today we'll be focusing on US unemployment claims, which will be very, very pivotal for trading in the market today. So we're expecting that to come into the market around 2:30 p.m. today. So market is already expecting that we'll have a higher unemployment claims. Should this be the case, should the data be actually released and we get data that is higher than 215 unemployment claims, you know what that means? It means that we'll have some form of weakness coming to the dollar. Should we have one that is lower, like very lower than actually for previous week, and this, I think the strongest reaction will come from when we get a data that is lower than previous week, and the forecast dollar will get the much needed strength that it needs to continue to push higher, to rally and the likes like that. So this is a very important event. But before that, we have a GDP data for the UK economy. 8 a.m. this morning. Market is already forecasting a GDP that is higher than previous, where we had a negative number, minus 0.1%. Now, market is forecasting a 0.1% increase in GDP in UK on a month-to-month basis. So I have to wait and see before we react. So we are still, these are currencies that will be doing the heavy lifting for us. We have marked them out since 2025, and we wouldn't be changing much here. Is currencies we want to buy on the left hand side, the currencies we will be interested in selling for the long term on the right hand side. So there are different nuances that determines what we do with each pair, and all that's based on data that come into the market in favor of or against any of this pair. Trading is simple in the sense that all you need to do is to pair the strong currency with the weak currency when you are buying, or vice versa when you are selling. So it's as easy as that. When I move into the chart, I'm only be doing a total analysis of one of this pair on this left hand side and one of this pair that we're interested in selling on the other side, just not to make the video unnecessarily long. So let's move into our trading chart. This is a 3 months time frame. You can also call it a quarterly time frame for the dollar. This is the lowest low, and this is the most recent highest high. This is the most recent high, like the highest high. So market has been between here and here. So this is where we are currently. For us, we would like to see market close this market value gap here, this fair value gap here, this fair value gap here. Depending on data, we'll continue to see, perhaps we'll continue to see, have data that will support dollar towards pushing towards our projection. So one of the ones we will be interested in today is, should we continue to see a low unemployment claim data today interest us to buy dollar? Because on the long time frame we can see that from here to here, market is currently at a discount price. I don't even need to draw the Fibonacci to show this. You can see slightly below the 50%, the equilibrium level. We are here in the monthly time frame. Market has been consolidating since it retraced from this high. So we want to see market push price past this side and fill this sell side imbalance here and the likes. On the weekly time frame, we can say last week we have a solid push to the high, push to the upper side for the dollar on the backdrop of a strong unemployment claims and other data like that. That's helped strengthen the dollar. So this week so far, we have not really had positive data for the dollar, except from dollar being benefiting from high geopolitical risk in Venezuela and in Iran. So that's why we have seen some form of upside for the dollar on daily time frame. So this is Monday's candle. Tuesday, Wednesday. No, this is Monday, Tuesday, Wednesday. Today is Thursday. So any action we'll be taking here will be totally data dependent. Before even we come down to look at price, we want to make sure that we have a strong data for buying. If we have a weak data, particularly for the unemployment claims, that we are going to sell most likely. So that's that for dollar. Next pair we'll be looking at here is the USD JPY on the quarterly time frame. We are seeing dollar rallying. We are currently seeing a dollar that is strong, that is strengthened against the weak Japanese yen on the quarterly time frame. On the monthly time frame, same thing, pushing higher. They have taken out this high already. The next target could be at 162 level, 162 on the weekly time frame. Market have taken out this high. The next target is here, obviously, at 162 on the daily time frame. Today is Thursday, Monday candle, Tuesday and Wednesday. We had a lot of verbal intervention coming from Japan yesterday, from the Japanese finance minister and the likes, and a lot of policies going there. We even heard that the current prime minister dissolved a party or something of sorts. So that's what you can see when we look at yesterday's data. Despite that dollar was strong late in the day, Japanese yen was kind of the strongest currency in the market. So today's Thursday's data, should we see a weak data for unemployment claim? A data that suggests a higher unemployment claims, whether from previous data pushed in those of the markets or for continuous claims that is higher, then it's a no-brainer. Would be selling this pair, even though our projection is for a buy. That's what makes trading interesting. Just data. When you focus solely on price action or technical analysis, it's kind of noisy. The fundamental analysis make it easy to it helps your decision making when you get this kind of data, because I could be seeing a sell here, it could sell from here, it could continue a buy from here. So it just depends on data. And these investment banks don't just sit around their computers with technical indicators. They usually use information because they are moving a large amount of money. They just don't say, okay, RSI says buy, stochastic says this, and they keep opening trades and risking large amount of money. So you don't want to be that kind of trader. So this is for our analysis for a pair we're interested in buying For peers, we are interested in selling. Should I go with AUD card or JBP, CHF? I'm coming. Let me just quickly check the daily time frame. Let's stay with GBP CHF. Clearly, on the quarterly time frame, market has been bearish. That been dumping for most parts since 2008. This is even July. The highest high here was at formed 2nd of July 2007. Most part of 2026. This is first quarter, second quarter, third quarter, fourth quarter. It was bearish, so this is where we are. Perhaps we'll see a continuation if we get a stronger data, or should the Swiss National Bank find reasons to act on rates, perhaps, especially if they hike rates. I think this trend should continue. On the weekly time frame, we are currently retracing. Right now, we want to see possible, I don't know how long it will take for this fair value gap to be closed, whether it will be closed at all, or this high will be taken out. Whatever would happen, we just stay close to data from the UK and from the Swiss economy, and we just monitor and see what happens. On the weekly time frame, this had been taken out, so price could go either way. It all depends on data. It could buy, it could sell. Today we have the GDP month-on-month data. That's where we compare how the UK economy has been performing. We make comparison between the GDP of UK for December 2025 and what we had the last time the GDP was taken, which was November. It was negative. So should we get a positive data from the UK GDP, I believe that's the retracement will continue most likely. On the daily time frame, this is Monday, Tuesday, Wednesday. This liquidity pool sitting here has been taken out. Market might run lower. Should we have a lower GDP than, if the GDP comes out lower than what we had November, which was minus 0.1%, we might see this continue downward, and probably we can expect price to close the fair value gap here. Should we have a higher GDP, especially if it surpasses GDP figure for November, is a no-brainer. P continues to go higher, especially if we have a risk on market sentiment. This should be a good goal. In continuation, this should just be a retracement. Let's go to the 4-hour and see continuation closing the fair value gap here and running higher perhaps at the end of the week. So that is all for market's expectation for the pairs we are buying and selling. Other one do by yourself, usually for ones you have marked out to buy or to sell. So that will be all from the charts today. Stick with us next week as we break down market reactions, dollar performance, and commodities like oil, where the story in Venezuela could continue to echo. If you found these updates valuable, like the video, subscribe, and hit the bell to stay ahead in this volatile 2026 trading. I am your host, Renaissance Capital. See you on the next update. Thanks for watching.